Good evening, students. Welcome to the session. So today we are going to focus on the assessment of the various trust. Okay, we have done the assessment of the various entities. Now we are going to focus on assessment of the trust. So what are the kind of trust that we are going to look into it? Let us have a look. We are going to examine, first of all, a securitization trust, REIT and InvITs, alternate investment funds, charitable trust, and the private trust. Fine. So first, let's talk about the securitization trust. What is a securitization trust, students? Yes, what is a securitization trust? Very quickly, what is securitization trust? Yes, nobody knows the answer. Securitization trust is basically a special purpose vehicle which is set up for the purposes of generating the income from the assets. Okay. So what happens is in the case of the securitization trust, the bank usually give the loan by pledging the assets, by taking the pledge of assets from the borrower. Now bank, in order to monetize these assets, will give these assets to the securitization trust, which will give the funding to the bank. Right? So securitization trust basically operates in that manner. So now how is the income of the securitization trust taxable? Yes. How is the income of the securitization trust is taxable? In the hands of the investor. Very good, Geeta. So in the hands of the trust, we have the income exempt. Right? So the income is exempt in the hands of the trust. And this is taxable in the hands of the unit holder. Because securitization trust operates like a pass-through entity. Okay? It operates like a pass-through entity. Are we getting this particular point? Yes. So securitization trust operates in that particular way. Now, in terms of the securitization trust, which is there, the income will be taxable in the hands of the unit holder in the like manner as if the investor had directly invested in the underlying asset. So, let's say, for example, if the trust is generating the income of, let's say, 10 lakh rupees, which is distributed to the investor. Let's say there are 10 investors. So each investor gets 1 lakh rupees. Now let's say this 10 lakh, 2 lakh is from the under the head IFHP. Let's say 5 lakh is under the head PGBP. And 3 lakh is under the head income from other sources. So that the 1 lakh which will get distributed to the shareholders or the unit holders will also be taxable under the same heads in the ratio of 2:5:3. So 2 will go to the IFHP, 5 will go to the PGBP, and 3 will go to the IFRS. So the income of the securitization trust is exempt in the hands of the trust under section 1023 DA. And in case of the unit holder, this will be taxable in the hands of the unit holder in the like manner and is as per the same character and nature as if it was in the hands of the securitization trust. Are we clear about the securitization trust? Very simple. Yes. What is the TDS rate? What is the rate of TDS when the trust pays the income to the unit holder? What is the rate of TDS? Yes, what is the rate of TDS? It is the TDS is under section 194 LBC, 25 and 30%. Very good, Geeta. If the resident is the unit holder is the resident individual in HUF, it is 25%. If it is resident other than individual and HUF, it is 30%. And if it is a non-resident or a foreign company, then what is the TDS rate? What is the TDS rate? Rates in force. Very good, Geeta. Yes. So that is about the securitization trust. Next is alternative investment fund. What is alternative investment fund? What is an AIF? So investment funds are of different category. They invest in different asset classes, like in the startups, like in the debt securities. There are different kind of the investment fund, right? So how is the income of the investment fund taxed? Right? How is the income from the investment fund taxed? In case of the investment fund students, again, you have to see what is the category of the or the nature of the income. Okay. If it is income from other sources or income from other than PGBP, then in that particular case, the income shall be taxable in the hands of the unit holders. And it will be exempt in the hands of the AIF under section 23 FBA. Right? And what will be the TDS in the case of the income paid to the unit holders in that case? What shall be the TDS? No, Geeta. It shall be 10% if it is payable to a resident unit holder, and if it is payable to a non-resident, it will be at the rates in force. And the income will be taxable in the hands of the unit holder as it was in the case of securitization trust itself, meaning in the nature of the income and the character of the income will remain the same. So let's say, for example, if the income is chargeable under that IFHP, in the hands of unit holder also, it will go under the head IFHP. Right? And if it is the income in the nature of PGBP, then it will be taxable in the hands of the AIF. If the income is in the nature of the PGBP, then in that particular case, it will be chargeable under the chargeable in the hands of the AIF. And therefore, it will be exempt in the hands of the unit holder. Now, what will be the tax rate for the AIF? If the AIF is incorporated as a company, it will be 30% or 25% if it is gross receipts or turnover was less than 400 crores in 22-23, or 22% if it opts for 115 BA. If it is LLP or a partnership firm, it is 30%. If it is incorporated as AOP, BOI or trust, then it will be at the maximum marginal rate. In the hands of the investor, the income will be exempt. Now, what about the losses? If there are losses under the head PGBP, then since the income is taxable in the hands of the AIF, the losses shall not be allowed to be passed on to the investors. It will be set off at the fund level itself. However, if it is loss other than the PGBP loss, then it will be allowed to the investors to be set off only if the units have been held for a period of at least greater than equal to 12 months. Are we clear? Let us solve a question on this from the module. So this is the question. The following are the particulars of the four investment funds for previous year 24-25. Business income is given. Capital gain is given. Income from other sources given. Compute the total income of the investment fund and each unit holder for AY 25-26, assuming that each investment fund has 20 unit holders, each having one unit held by them for a period exceeding 24 months, and income from investment in the investment fund is the only income of the unit holder. And then the second part of question, we'll look at it later. So let's say first for the fund A, how will the taxability work in that case? $20 taxable in the hands of the unit holder. That's right, Geeta. So in the hands of the AIF, it will be exempt. The 20 lakh which is there will be taxable. So in the hands of each unit holder, it will be 1 lakh which will get taxable. And how the 1 lakh will get taxed is something like this. 80,000 under the head capital gain and 20,000 under the head income from other sources. Fine. Next, 2 business income, 14 capital gain, 4 IFOS. 18 lakh in the hands of unit holder and 2 lakh in the hands of the AIF. Yes, that's right. So when you say 18, it will be taxable in this way. 7:2. Right? Because 18 lakh which is there divided by 20 is 90,000. This is 7:2 ratio. So 7 will go into the capital gain and 2 under the income from other source. In the C, there is 2 lakh of loss of business income. There is 6 lakh of capital loss and there is 8 lakh of the income from other sources. How would this be tackled? 2 lakh loss carry forward by the trust? No, no, Geeta. So what you have to do is, see, this 2 can be adjusted against 8, right? You can set off the business loss. This is the current year loss, not the brought forward loss, right? This is the current year loss. This is the income of the previous year 24-25. This is not the brought forward loss. So the current year loss can be, business loss can be set off against the income from other source. So first you will do the set off within the income from other source itself, in the hands of the trust itself. So what remains is 6 lakh as the distributable income, right? So the 6 divided by 20, 30,000 will get taxed in the hands of the unit holder. And the unit holder will be able to carry forward the 6 lakh as the capital loss since they have held the unit for more than 24 months. Are we clear about this? The next part of the question is, if the investment fund C has the following income components for AY 26-27, what would be the total income of the fund and the unit holder for that year if they have a business income of 2 lakh, capital gain of 9 lakh, and the income from other sources 8 lakh? Capital gain will get set off against the capital loss. Yes, Geeta, that's correct. So this business income of 2 lakh will get taxed in the hands of the AIF. This 6 lakh loss will get set off against 9 lakh. So 3 lakh divided by 20, which comes to 15,000 will be taxed in the hands of the unit holder. And this 8 lakh divided by 20, 40,000 will get also taxed in the under the head of IFOS in the hands of the unit holder. Last is D. Business income is 5. Capital gain is 20. IFOS is 2. IFOS set off against the business income. Very good, Geeta. And then balance 3 lakh will be taxable in the hands of the trust, and 20 lakh divided by 20, 1 lakh will get taxed under the head capital gain in the hands of the unit holder. Fine. So first you need to do the set off within that level itself, and if any loss then remains, that can be either carried forward by the trust depending on whether it is a business loss or if it is other loss, then in that case it will be carried out by the unit holder. Okay. Let us move to now the third trust, which is the REIT or InvIT. Now, what are the REITs or InvITs? Yes. What are the REITs or InvITs? Company invest in trust? Not really, Geeta. It is the real estate investment trust which invest in the underlying asset, which is the immovable property. That is the concept of the REIT or InvIT. Okay, these are SEBI registered entities. So how the REITs function is basically the real estate investment trust which are there. They are regulated by the SEBI. Okay. Now it is set up in the form of trust itself. It could have a sponsor who is sponsoring the trust, right? Or the settler, as you call it. Now, how does it function is that, let's say, for example, there will be a direct sponsor, or it may be held through a company, as you said. It's not necessary that it is always held through a company. It may be held through a company. It may be held directly through the sponsors. Now, if it is held through a company, let's say, for example, there is already a company which is existing, we will call it as a special purpose vehicle. Why we are calling it as a special purpose vehicle is because we are saying that, okay, the object of that company is to invest in the REIT. To invest in the REIT. So therefore, I am calling it as a special purpose vehicle because the object is a specific object for which this company has been incorporated. So I already have this company, right? I already have this company, a SPV that I'm calling. SPV is a normal terminology. It is not something that, it is called as a tax law. SPV is just a normal terminology. So when I say that I already have a company, now this company wants to invest in REIT. So how would it do it? So if the company now wants to invest in REIT, okay? So, sorry, the REIT wants to invest in a company, not the company. The REIT wants to invest in a company because now it doesn't want to basically hold the investment directly in immovable property. It will hold it through a company. So the company is incorporated basically to hold the immovable property. So there is already a company which was existing. So the shareholders of the company will also be there, right? So for the REIT to become a shareholder of the company, what REIT will do? REIT will ask the shareholders of the company, the existing shareholders, to give away their shares to REIT. Yes or no? So these shareholders will give away their shares to the REIT. So then REIT will become the shareholder of the SPV, or REIT will become the shareholder of the company. So these shareholders, the existing shareholders of the company, will transfer their shares to the REIT. And in return, obviously, they should get some consideration. What is the consideration that they will get? Units of the REIT. So REIT will say to the shareholders that, look, I want to buy this company because it is holding some immovable property. So I directly want to buy the company. So you give me the shares of the company. That's how you buy a company. In return, I will give you the units of my REIT. Now, this transaction, wherein the shares are transferred in exchange of units of REIT, is not considered as a transfer under Section 47. Means this is not taxable. Yes. So now if the shareholder also is a company, if the shareholder is also a company, let's say one company holds another company. So if the shareholder is also company, so in the P&L of the shareholder, what you will do? You will book the notional gain or loss. Notional gain or loss on what? On the transfer of shares of SPV against the units of REIT. You will have some gain or loss, right? That's a notional gain. You have not actually sold the shares of SPV. You have just transferred in exchange of units of REIT. So there is some notional gain or loss that you would have, which is a book entry, right? That you will book it into the P&L. So if you take that to P&L, what will happen? There will be MAT attracted on this. So, but under the MAT, if you remember, I told you, there's a specific adjustment under 115GB. You have to reduce this notional gain or loss from the book profit for the purposes of the MAT calculation. Yes, do you recollect this? So if you recollect here, we had done this particular adjustment wherein I had said notional gain or loss on the transfer of share of SPV in exchange of units of business trust have to be reduced or added in case of loss. And whatever when I sell the units of the business trust, when I will actually sell the units of the business trust, at that time, the actual gain or loss which will happen, that I will add or reduce in the MAT calculation. So when these shareholders will sell the units of REIT, at that time, whatever gain or loss will be there, that will get added in my book profit. So when the units of the REIT are actually sold, gain or loss shall be added or reduced from the book profit. Are we clear? Yes? Yes or no? Okay? Yes. Now, what will be the units of what will be the period of holding of the units of the REIT for the shareholder? When the shareholder will sell the units of the REIT, what will be the period of holding for that? Yes, when will the period of holding will start for the units of the REIT? From the original share. That's right. So the period of holding as per 242A will include the period of holding of the shares of the SPV. But what will be the time limit? 12 months, 24 months, 36 months. What will be the time limit? Yes, very good, Geeta. So if it is if the transfer takes place prior to 23rd July 2024, the period of holding is 36 months for the long-term capital asset. If the transfer takes place after 23rd July 2024, then in that case, the period of holding will be considered as 12 months. Okay? And what shall be the tax rate in case of STCG? What shall be the tax rate? Yes, very good, Geeta. So if it is a short-term capital gain, if it is the transfer takes place prior to 23rd July, it will be 15%. If the transfer takes place after the 23rd July, it will be 20% plus surcharge and cess. What will be the tax rate for the long-term capital gain? Yes, correct. So for the long-term capital gain, earlier, before, if the transfer takes place prior to 23rd July 2024, then it will be 10%. It will be 10%, Geeta, not 20%. It is 10% if the LTCG exceeds 1.25 lakh. However, if the transfer takes place after 23rd July, then it will be 12.5% if the LTCG exceeds 1.25 lakh plus the surcharge and the cess. Are we clear? What will be the cost of acquisition of the units? What will be the cost of acquisition of the units? At the time of purchase, what is the purchase of what? The cost of acquisition of these shares will become the cost of acquisition of units under section 49 2AC. Okay, so this is the first part of the REIT. Now, when the REIT generates the income, okay, when the REIT generates the income, so let's say first the REIT generates the income directly by holding the immovable property. So if it holds the immovable property directly, it can generate the rental income, right? It will generate the rental income. How will the rental income get taxed? Yes, rental income exempt in the hands of trust. Very good, Geeta. So the rental income which is there will be exempt in the hands of the trust under section 1023 FCA. So with respect to the rental income, it will be a pass-through status given to the trust. So this will be therefore taxable in the hands of the unit holder. Now, when the payer pays the rental rent to the REIT, since the rental income is exempt in the hands of the REIT, the payer is not required to deduct the TDS under section 194I. Right? And when the REIT distributes the income to the unit holder, the REIT will deduct the TDS under 194 LBA. If it is a resident unit holder, then at the rate of 10%. If it is a non-resident unit holder, at the rates in force. Now, how will the characterization of the rental income will be? Will it be taxable under IFHP or will it be taxable under PGBP? Because it is actually the business of the REIT to hold the immobile property and generate the rental income. Business income kita no. So as per the explanation 3 to section 28, income from the residential house property will be specifically taxable under the head of income from house property and not under the business profession, even if it is your business to give the properties on the rent. However, if it is the commercial property, then if it is your business to let out the commercial property, it will be taxable under the head PGBP because then you can use the Chennai property ruling case. But the Chennai property ruling case has been overridden by way of the express amendment to the section 28 in terms of the residential house property. So for residential house property, it will be specifically taxable under the head income from house properties. Are we clear? Now, second source is the REIT can generate the income through the SPV. So SPV gives the property on the rent and gives the dividend or interest to the unit holders. Sorry, to the REIT. So if the REIT gets the dividend from the SPV, how will the dividend get taxed in the hands of the REIT? How will the dividend be taxed in the hands of the SPV? So in the hands of the REIT? Yes, Geeta, very good. So the dividend which is received from the SPV by the unit, by the business trust will be exempt in the hands of the business trust under section 1023 FC. And also the SPV, when it distributes the dividend, is not required to deduct the TDS under section 194. So it will then be therefore taxable in the hands of the unit holder. However, in the hands of the unit holder, you need to ask a question. Whether SPV has exercised the option of taxation under 115BAA of 22%. If the answer is yes, if the SPV has exercised the option of 115BAA concessional tax rate of 22%, then in that particular case, the dividend shall be taxable in the hands of the unit holder. If the SPV has not exercised the concessional tax rate of 22%, meaning it goes for 30% tax rate normally or 25% tax rate, then dividend is also not taxable in the hands of the unit holder. Are we clear? And when the REIT pays to the unit holder, what will be the TDS rate? Yes, just give me a minute. Yeah, I'm so sorry for technical interruption. Yeah. So when the trust distributes the dividend to the unit holder, what will be the TDS in that case in the hands of the unit holder? There will be TDS which will be applicable in the hands of the unit holder. Yes, Geeta, very good. So in case of the unit holder which is a non-resident, it will be 10%. Right? It will be 10%. Or see, 10% is you have to write like this in the exam that the TDS rate cannot be basically less than the tax rate. Right? The tax rate is basically 10%. However, if you look at section 115A, under 115A, the TDS is actually 20%. So the tax rate is actually 20%. So if you look at section 115A, which talks about the taxability of the non-resident on the receipt of the dividend income, you will find that it is 20%. However, under 115 UA, if you look at it, the tax rate is not given specifically. So there's a view which is taken that ideally the tax rate should be same as the TDS rate, which is 10%. According to me, if you ask me, the correct view is that the tax rate should be 20% itself. But the module has given two views, so you have to write it accordingly. TDS under 194 LBA is given as 10%. If it is a resident unit holder under 194 LBA, the TDS is 10% and the tax will be at the normal rates of tax. Okay. So the module has given the view that actually the TDS rate cannot be less than the tax rate, but I don't think that is, correct. So based on that view, they have said that the tax rate should also be 10%. However, if you look at 115A, which talks about dividend in general, it says the dividend income is taxed at 20%. So both views are possible and you can write it accordingly in the examination. Next, the REIT can generate the interest income from the SPV. Now, if it is generating the interest income from the SPV, how will it be taxed in the hands of REIT? IFOS? No, Gita. It will be exempt in the hands of the REIT under 1023 FC. And accordingly, the payer of the interest, the borrower, is also not required to deduct the TDS under Section 194A. In the hands of the unit holder, it will be taxable under 115 UA. However, at what rate it will be taxable? So it will be taxable at 5% in the case of non-resident and at the normal rate of tax in the case of resident. And there will also be a TDS which the REIT will have to deduct under 194 LBA, which shall be 5% in case of non-resident and 10% in the case of the resident. Now, REIT can also pay the interest on the loan taken from other non-resident. REIT can also, sorry, the SPV or the REIT can also borrow the funds from another non-resident, right? In order to grow its business. So, if a REIT pays the interest to any non-resident, that will be also liable to TDS at the rate of 5%. And if it is borrowed through the rupee denominated bond listed on the IFSC, then it shall be 9%. Are we clear? Yes. And any other income which is earned by the REIT, it can be any other income, right? For example, it can be capital gain. So if the capital gain is earned by the REIT on the sale of asset, how will that be taxable? How will the income from capital gain on sale of assets by REIT will be taxable? So in case of the long-term capital gain, 112 section will apply. Yes, it will be taxable in the hands of the REIT. But in case of long-term capital gains, it will be under 112. In case of short-term capital gain, it will be taxable under 111A. And case of other than short-term capital gain covered under 111A, it shall be taxable at maximum marginal rate. Are we clear? So all the long-term capital gains, 112 will apply, 112A will not apply. For your attempt, 112A is not applicable for the REIT. When the REIT sells the asset, all the long-term will be covered under 112. Short-term, which are covered under 111A, 111A will be taxed under 111. Other than that, will be taxed at the maximum marginal rate. And this income will be exempt in the hands of the unit holder. Any other income of the business trust, which is there, will be taxable at the maximum marginal rate in the hands of the business trust. And on the distribution, this will be exempt in the hands of the unit holder. Are we clear? Yes. Next is the repayment of capital. So let's say if there is any distribution by the REIT to its unit holder, which is not in the nature of the income, which is not in the nature of dividend, interest, right? Or which is not in the nature of rental income, or any other sum which has already been taxed in the hands of business trust under 115 UA. Basically, which is in the nature of repayment of the debt given or the redemption of the capital. This is going to be taxable under section 56 to 12 under the head income from other sources. How will this be taxable? It will be A minus B minus C. What is A? A is the aggregate of all the distribution made by the business trust to the unit holder, which is not in the nature of income, which has already been taxed either in the hands of unit holder or in the hands of the business trust. Basically, other than dividend, interest, rent, capital gain, or any other sum which is chargeable in the hands of the unit holder or REIT. B is the cost of units of business trust. And C is if amount is already taxed in earlier previous year. Because in the A, you take the aggregate of all amounts for either this year as well as the previous year. And in the C, you will reduce that amount. And if A minus B minus C is loss, 56 to 12 will become 0. Are we clear up till this? Yes. Now this 56 to 12 is applicable if the repayment is to the extent of is over and above the cost of units of business trust. So if you are having the units of cost of units as let's say 110 and I am paying you 150 per unit. So then it will be taxable under section 56 to 12. However, if I am paying you 110 itself, then in that case, you will reduce the distribution from the cost of acquisition under the head capital. So basically, to the extent of cost of units of business trust, you have to reduce the distribution from the cost of acquisition under the head capital. However, if it is over and above the cost of units of business trust, you will then tax under 56 to 12. So let us say, for example, if the cost of unit is 1,000, and let's say the distribution by REIT is 1,500 and the second instance is 2,000. And out of this, interest from SPV is 500, STCG on sale of shares is 200, other income is 100. So what I will do? From this 1,500 distribution, I will reduce the amounts which have already been taxed either in the hands of unit holder or in the hands of REIT. Interest from SPV is taxable in the hands of the unit holder, so I'll reduce that. STCG on sale of shares is also taxable in the hands of REIT under 111A. Other income will get taxed in the hands of REIT at the MMR, so I will reduce that. So how much it comes to? Yes. 700. And what is the cost of units? 1,000. So what I should do? I need to then reduce from the cost while calculating the capital gain. In the year of sale of units, I will reduce from the cost of acquisition 1,000 minus 700. The cost of acquisition will become 300. Are we getting this particular point? And in the next case, if you look at where I am taking 2,000, if I reduce from 2,000, 500, 200 and 100, which will give me 1,300. So in that particular case, or 1,600, right? I will charge this under 56 to 12, 1,600 minus 1,000, 600, and under the capital gain, there will be no effect. 1,600 or 1,300, whatever it is. So are we clear with this? Yes? Okay. Let's solve a question from the module, therefore, on this. Okay. A business trust registered under SEBI regulations 2014 gives the particular of its income for the previous year 24-25. Interest income from Beta Limited 4 crore rupees. Here, you are required to discuss the tax consequences of the income earned by the business trust in the hands of the business trust as well as the unit holders, assuming that the business trust has distributed 10 crores to the unit holders in the previous year 24-25. Assume that beta does not opt to pay tax under 115BAA. So what will happen to this interest income of 4 crores? Exempt in the hands of the REIT due to the pass-through status. Yes. And this beta is not required. You will write like this, that the beta is also not required to. How will it be exempt in the hands of both, Geeta? You will write that the beta is also not required to deduct the tax at source on the interest income paid to the business trust under 194A. This will be taxable in the hands of the unit holder in the nature of the interest income itself. And what will be the taxability? Out of the 10 crores which is there, which is distributed, you have to distribute into the ratio of 4 is to 11.1. For 11.1 is the total income of the business trust. So this portion will be taxable under that income from other sources. And the business trust has to deduct the TDS at the rate of 10% if the income is distributed to a resident unit holder and 5% if the income is distributed to a non-resident unit holder. Geeta, 115BAA, whether it is opted or not, that is for the dividend income. Interest income is always taxable in the hands of the unit holder. That taxability of that doesn't depend on the 115BAA opting off by the SPV. Okay. Now, dividend income from Beta Limited is 2 crores. Now, what will happen in that case? Exempt in both hands. So, dividend income, when the Beta distributes to the business trust, it will be exempt in the hands of business trust by virtue of 1023 FC. You have to also write that the beta is not required to deduct the TDS on the dividend component under section 194. Even business trust is not required to deduct the TDS on the dividend component distributed to the unit holders. And since the SPV has not exercised the option under 115BAA, in that particular case, this dividend will also be exempt in the hands of the unit holder. Short-term capital gain on sale of listed shares of Beta transferred on 1/9/2024, 1.5 crores. Taxable in the hands of business trust at what rate? You have to mention the rate also because they have given you the date. So you need to mention the rates also in the exam. This is taxable under 111A because it is a listed share at the rate of 20%, Geeta, not 15, because the transfer has taken place after 23rd July 2024. And in the hands of the unit holder, this income will be exempt. Are we clear? It will not be 15%, Geeta. Okay. Short-term capital gain on sale of developmental properties, 1 crore. Yes. Yes. Taxable in the hands of the business trust. Short-term capital gain at what rate, Geeta? It is mentioned short-term, right? Where is it not mentioned? So at what rate this will be taxable? at the maximum marginal rate. This will be taxable in the hands of the business trust at the maximum marginal rate. It is other than that covered under 111A. And there will not be any tax liability in the hands of the unit holder. Are we clear? Interest received from investments in unlisted debentures of the real estate companies, rupees 10 lakh. Yes. This is any other income, right? This is interest received not from SPV but from the unlisted debenture. So yes, this will be taxable at the maximum marginal rate in the hands of the business trust, and this will be exempt in the hands of the unit holder. Last one, rental income from directly owned real estate asset 2.5 crores. Yes. So this will be exempt in the hands of the business trust, and this will be taxable in the hands of the unit holder. Now, the payer of the rent need not deduct the TDS under 194I. However, the REIT has to deduct the TDS at the rate of 10% in case the distribution is made to a unit holder, and at the rates in force if the distribution is made to a non-resident unit holder. And this shall be taxable in the hands of the unit holder at the ratio of 2.5 to 11.1. Are we clear about the REIT concept? Yes or no? Okay. Now let us now move towards the charitable trust. So under the charitable trust, there are two regimes which operate. Okay, there are two regimes which operate. Revised rates as in? Geeta, I didn't get your question. Okay. So under the charitable trust, you have two regimes. Yes, there are many rates, Geeta. You have to remember these. There is no option. In case you can't remember, then you can just, write that the TDS will be deducted, but make an attempt to reduce it, remember it. Okay. So now, under the charitable trust, there are two regimes. Under the first regime, which operates under section 1023C. The second regime operates under section 11 to 13. Now, under 1023C, there are certain specific trusts which exist. Okay, specific trust as in Clean Ganga Fund Trust, Prime Minister National Relief Trust, all of those, which have the unconditional exemption. Second are education trust existing solely for educational purposes and not for the purposes of profit. Or the medical institutions, both of which are wholly and substantially financed by the government. Now again, these kind of trusts are unconditionally exempt, meaning they do not need any separate registration. They are unconditionally exempt. They don't have to fulfill any condition. What do we mean by the educational trust existing solely for educational purposes? So you have the decision of the New Noble Educational Society case. What does that decision say? That the solely means exclusively and not predominantly, meaning I should only be engaged in undertaking the educational activity. If my objective of the university institution is not just to take education but also to earn profit, then I'm not an institution working solely for education. Solely for educational means that I should only be working for educational. My objective should not be to earn profit. If I earn the profit, if I earn the surplus, there is no bar on that. But how do I utilize that surplus? That if I reinvest that surplus in providing the education itself, then I will be called as an institution existing solely for education. But if I take the profit back home, then I'm not an educational institution. For example, if we talk about the coaching institutes, they are not the educational institutions which are existing solely for educational purpose because they have the profit motive. They would want to take back some profits back to home. They would not reinvest the entire profit to advance the activity of education. So therefore, in that case, it will not be called as an education institution. So there is no bar on generating the surplus, but if the surplus is utilized for the educational activity, then there is no problem. And if the institution which is there is providing some ancillary facilities, like hostel facility, bus facility, library facility, sale of books, these are all incidental to the object of imparting education. And if they maintain the separate books of accounts for these incidental activity, then it is also called as an educational institution existing solely for the educational purposes. And these are not for the purposes of profit. Or the medical institution which are wholly and substantially financed by government. What do we mean by wholly and substantially financed by government? Where the government grants are greater than equal to 50% of the total receipts. And then the third category is educational institution existing solely for educational purposes and not for the purposes of profit, or the medical institution which are not financed by the government, but where the combined annual receipts are less than equal to 5 crores. So if let's say for example the university's receipt is 4 crore and hospital is 3 crore, the total receipts are more than 5 crore, but their individual receipts are less than 5 crore. So in that particular case also they will not fit into this category. Now, these all the three category A, B, C, the specific trust, the education or the medical institution substantially financed by government, the educational institution or the medical institution which have the annual receipt less than 5 crore, all of these have the unconditional exemption, meaning they do not require separate approval. The educational institution will also cover the courses which are offered in the category of diploma and certificate courses. Okay. Then the fourth category is the charitable, religious trust, medical institutions, educational institution whose annual receipts are more than 5 crore. Now, these kind of trust can only get the exemption under 1023C if they obtain the specific approval. Now, the approval for these trusts or institutions can only be obtained under 1023C before 1st October 2024. And if the approval has been given, then only they can go and claim the exemption under 1023C. Otherwise, for this fourth category, after 1st October 2024, they can only obtain the approval under section 11 to section 13. Meaning for this category 4, now there will be only one regime, which is under section 11 to section 13 after 1st October 2024. But for the other three categories, for the institutions financed by the government, for the institutions which are having the annual receipts less than 5 crore, they are still governed under 1026. About the second regime, it says income from the property held under the trust wholly or partly for charitable or religious purposes is exempt under section 11. Now, what do we understand by the term charitable purpose? Charitable purpose has been defined under section 2, subsection 15. What does it include? Yes. Yes, Geeta, correct. So it includes relief of poor, education, yoga, medical relief, preservation of environment, preservation of monuments, and most importantly, advancement of any other object of general public utility. Okay, advancement of any other object of general public utility. Now, advancement of any other object of general public utility will not include the activities where they are carried out in the nature of the trade or commerce. If the activities are undertaken in the nature of trade, commerce, or business, either for cess or fee, irrespective of how the proceeds of that trade or commerce are utilized, it would not be regarded as advancement of the object of general public utility. The term advancement of the object of general public utility has not been defined. However, the Supreme Court has observed that where the business which is held under the trust, where the predominant purpose was for the development of the infrastructure of the country and where there was no profit motive, right? Then it is a case of the advancement of object of general public utility. However, when you're carrying out the activity on a commercial basis, then it is not in the nature of the advancement of object of general public utility. So if you're carrying out any trade, commerce, or business, then it is not the advancement of general public utility, even if you utilize the amount for the benefit of the charitable activity. So even if you utilize the proceeds of business for charitable activity, it doesn't make you the charitable institution. However, there is an exception to this rule, which says that if the activities are undertaken, if the trade, commerce, or business is undertaken in the course of carrying out the actual advancement of the object of general public utility, and the receipts from the activity are less than 20% of the total receipts, then even if the activity are in the nature of trade, commerce, or business, it shall be regarded as advancement of any other object of the general public utility. And this is applicable, this exception is only applicable to the advancement of any other object of general public utility. In all the other A to F objects, this 20% criteria is not to be checked. So when in A to F, even if the trading receipts are greater than 20% of total receipts, it will be regarded as the charitable activity. Now, the Supreme Court in Ahmedabad Urban Development observed that how do you identify what is charitable, what is advancement of object of general public utility? You need to see whether the markup on the cost is significant or it is minimal. If it is significant, then I can say it is engaged in the trade, commerce, or business. And then you need to test whether the activity, receipts from that activity are greater than 20% of total receipts. If the profits are nominal, then you're not carrying out the trade, commerce, or business. And if your activity from that profits is incidental to the object of general public utility, plus you maintain the separate set of books of accounts, then you are not engaged in the trade, commerce, or business. Let us look at some of the examples from the module. An institution having its main object as advancement of general public utility received 30 lakhs in aggregate during the previous year 24-25 from an activity in the nature of trade. The total receipts of the institution including donation was 140 lakh. It applied 85% of its total receipts from such activity during the same year for its main object, that is advancement of the object of general public utility. What would be the tax consequence of such receipt and the application by the institution? Yes. What would happen in this case? Trade receipt is more than 20%, so taxable. Yes, good, Geeta. So, what is the 20% of 140 lakh total receipt? 28 lakh. I have received 30 lakh, right? So, the receipts from the trade are more than 20% of the total receipt. Now, irrespective that I applied 85% of this 30 lakh for the advancement of general public utility, doesn't matter. I am doing a trade, commerce, or business, and I'm not fitting within the exception, so I would not be able to retain the charitable status for this year. So I will lose out the charitable status and I will not be eligible for the exemption, even if I'm applying 85% of the trade income for the object. Are we clear? Would your answer be different if the institution's total receipts were 150 lakh instead of 140 lakhs? Yes. Yes. Correct, Geeta. So if the institution is having 150 lakh, then 20% comes to 30. And I have received 30 only. So there I can claim the exemption because I'm falling within the exception. Last one. Would your answer be, what would your answer if the main object is the relief of poor and the institution receives 30 lakh from a trading activity when its total receipts are 140 lakh and applies 85% for its main object? Yes. Main object is relief of poor, so exemption is available. Yes, because in that case, the 20% threshold doesn't apply. So even if it exceeds 20%, it's fine. You will still retain the charitable status. Next one. Save Wildlife, an institution having its main object as preservation of wildlife, use the entire income derived from the activity in the nature of trade for its main object during the previous year, 31st March 25. Would such utilization of its income be treated as utilization for charitable purpose? Examine. Would your answer be different if the main object is the advancement of the general public utility? Yes. Yes. Correct, Geeta. So here, 215 includes the protection of the wildlife, right? So if the institution is carrying out in the nature of trade, commerce, or business activity, right? In that particular case, the restriction of more than 20% doesn't apply to the that particular thing. But if it is carrying out the object of the advancement of general public utility, then if it is deriving the income from the trade, it has to see that the income does not exceed 20% of the total receipts. Okay? Now, if it is doing a business activity which is incidental, as I said, it needs to maintain the separate set of books of accounts to claim the exemption even for the business income. Let us look at this question. NSN, a charitable educational institution approved under 1023C, is running a school. It operates a stationery shop outside the school campus. A sum of rupees 75 lakh has been derived as a net income from the business activity, which has been applied towards the object of the trust in providing the education. The trust maintains a separate books of account, examine the taxability of the application if the income is so derived relates to previous year 24-25. Yes, very simple. The trust is providing the education. It is a charitable trust. It runs a stationery shop, which is incidental income. It maintains a separate books of accounts. So the exemption will be available even in respect of the business profit. Are we clear? Few more questions regarding the N23C, which we'll cover here. An educational institution having the annual receipts of 3.8 crores has availed the exemption under 1023C. AO has denied the exemption on the ground that the educational institution has not made the application to the prescribed authority for approval under 1023C. Examine the action of the AO. Yes, exemption is available without making the application because the turnover is less than 10 crores. Sorry, 5 crores. Okay. A not-for-profit trust undertakes the philanthropic activities to an educational institution and a hospital. The trust had the annual receipts of 3 crore from educational and 4 crore from the hospital. It desires to avail the exemption under 1023C as the individual threshold is less than 5 crore. Can it do so? No. As the combined receipt is more than 5 crore, it will not be able to do so. Are we clear? Okay. Now, moving towards how do the trust obtain the registration? What is the process of obtaining the registration for the trust? So the trust first have to claim under 1023C if we talk about, the trust have to obtain the approval and under the section 11 they have to obtain the registration to avail the exemption. Under 1023C before 1st October 2024 only they could do that. If the trust is a medical institution or an educational institution which is existing solely for education, not for profit, and they have been substantially financed by government or their annual receipts are less than 5 crore, then they don't need to obtain any approval. But if the approval now needs to be obtained under 1023C after 1st October 24, it can't be done. Now, what is the process for the registration under 11? So, if you have commenced the activities, then you can directly apply for the final registration. You can directly apply for the final registration. But if you are yet to commence the activity, you have to apply for the provisional registration. Are we getting this? So, if you have already commenced the activity, then directly apply for the final registration. So, a trust which has already commenced its activity and has not availed the exemption, it need not apply for the provisional approval. It can, after the commencement of activity, directly apply for the final approval in Form 10AB for any previous year ending before the date of such application. And to whom the application has to be made? It has to be made to the Principal Commissioner of Income Tax or the Commissioner of Income Tax. And they can approve the registration within 1 month from the end of the month in which the application has been made. Okay, sorry, within the 6 months from the end of the month in which application is received. Or if they are not satisfied looking at your activities, they will reject it. Once they have given you the approval or the registration, it shall be valid for a period of 5 years. After 5 years, then you can renew it. So now this, once you get the final registration, it will be valid for a period of 5 years. And this exemption will be given from what point in time? It will be given from the point in time from the financial year in which you made the application. Are we clear? Yes or no? So that is the final registration. Okay. So within 6 months of the commencement of activity, you can directly apply for the final registration in Form 10AB. And if you have not commenced the activity, then 1 month prior to the commencement of the previous year, you can apply for the provisional registration. And within 1 month of your application, the CIT or CIT will give you the PCIT or CIT will give you the provisional registration, which will be valid for a period of 3 years, and the exemption will be available to you from the previous year or the AY for which the registration is sought. Are we clear? In the case of the provisional registration, the CIT or PCIT will not examine your activities. They will give you the registration provisionally. Under the final registration, they will examine everything. But under provisional registration, they will not examine anything. And after 3 years, you have to again apply for the final registration. At least 6 months before the expiry of the provisional registration. And the final registration again will be given to you for a period of 5 years. And exemption will be available to you from the year in which the provisional registration was granted, from that previous year. If your final registration is going to expire, the 5 years period is going to expire, and now you want to renew it, again you can apply for the renewal at least 6 months prior to the expiry. And within the 6 months from the end of the month, or from the end of the quarter in which the application was received, the application will be sanctioned or rejected. And again, it will be approved for a period of 5 years from the AY in which the application is made. If you undertake the modification to the objectives, if you undertake the modification to the objects of the trust, then within a period of 30 days from the modification, you have to apply for the fresh registration, and that shall be given to you within 6 months from the end of the quarter in which application is made. from the and the exemption will be applicable from the year in which the application is made. If you do not apply for a fresh registration, if you modify your objects, then the accreted tax will be applicable under 115T, which don't mind. Are we clear? Yes. So let us look at this. A public trust has commenced the activity of providing relief to poor. The trust intends to claim the benefit of 11 and 12. It approaches you in October 2024. Advise the trust as to the time limit for making an application. So as I said, now it has what? Commenced the activities already. So what it needs to do? Yes, what it needs to do? If the trust has already commenced the activity, what it needs to do? It needs to directly apply for the final registration. To the CIT or PCIT, and CIT or PCIT, looking at the facts, genuineness of the activity will grant the registration within 6 months from the end of the quarter in which application has been made. And it will be valid for a period of 5 years. Next is help all, a trust created in 23 for providing relief to poor applied for registration on 28 February. The commissioner denied the registration on the ground that the trust has not commenced any activity due to which he cannot satisfy himself about the genuineness of the trust. Is the ground for denial of registration justified? No, right? Because if the trust has not commenced the activity, the commissioner will have to give it the provisional registration for a period of 3 years without making any detailed inquiry. Because the activities are not commenced, how will they make the inquiry? Once the trust, after 3 years, apply for final registration, then of course the commissioner can make the detailed inquiry. Now at this stage, it doesn't need to apply any detailed inquiry and give the provisional registration. Are we clear? Yes. So let us take a break at this point in time and then we start back again with the computation of the income of the trust. Let's take a break. Manishji, break. Okay. So now, students, let's move to the computation part of the trust. So, statement of total income is what we have to prepare. First is income from the property held under the trust for charitable or religious purposes. Here, the view can be that the word is the income, right? So you may take the net receipts. That is basically the receipts minus the expenses. But the module, if you look at it, the view that has been taken by the institute is that this only includes the gross receipts. So income here means the gross receipts and not the net receipts. So you need to take the gross receipts over here. As per the Supreme Court ruling in the program for community organization. Then you take the voluntary contributions other than the corpus donation. What happens to the corpus donation? Yes, corpus donations are not taxable, except if the anonymous donations are received as the corpus donations. Then those are taxed under 115 BBC. Otherwise, the corpus donations are exempt. That is not considered as your income, provided you deposit it into the modes specified under section 11.5. Are we clear? And if you receive the corpus donation for repair or renovation of the religious trust, then also it is not considered as income, provided if you apply it for the purpose for which it was received, that is, you apply it only for the repair purposes. The amount is not utilized for making the corpus donation to another trust, or you invest it into the mode specified under 11.5. If you do not fulfill these conditions, then it is considered as deemed income taxable under section, with section 115 BBI. Are we clear? Third is the anonymous donation. How are the anonymous donations taxed? Yes, how are the anonymous donation taxed? Yes, not taxable total donation. No, Geeta. Yes. How are the anonymous donations taxed? Anonymous donation 115 PBC. Yes, very good, Geeta. So, for the anonymous donation, what you need to do is you need to see 5% of total donation or rupees 1 lakh, whichever is higher. Up to that limit, it is considered as normal donation. Beyond that limit, it is taxable under 115 BBC. And it is taxable at the what rate? At the rate of 30%. At the rate of 30%. Okay. So, anonymous donations which are there, that will be taxable under 115 BBC beyond this limit. Now, total donations will include what? Voluntary contribution, anonymous donation, corpus donations also. However, 115 BBC is not applicable if the trust is created wholly for religious purposes, or trust is created for partly religious, partly charitable purpose, but the donations are received for the educational or medical institution. Are we clear? However, if the anonymous donations are received as a corpus donation, then the exemption which is available to the corpus donation is not applicable. Are we clear? Yes or no? Okay. So let us look at again the question from the module. We have three situations. Total donation, let's say the first situation is 15 lakh. Anonymous is 4 lakh. So what will be my exemption here? 5% of 15 lakh or 1 lakh, whichever is higher. So 1 lakh, right? So out of 4 lakh, 1 lakh is considered as normal donation, which is eligible for the application of income, right? The balance 3 lakh will be taxable at 30%. Are we clear?
Yes, ma'am.
Again, 30 lakh with 5% of that or 7 lakh. Sorry, or 1 lakh, whichever is higher. So 1 lakh 50. Now out of 7 lakh, 1 lakh 50 will be taxable at normal, right? 5 lakh 50 will be taxable at 30%. Similarly, in the C point, if we look at 40 lakh, so 5% of that is 2 lakh, 2 lakh or 1 lakh, whichever is higher is 2 lakh. So out of 10 lakh, 2 lakh will be taxable at normal rate, 8 lakh will be taxable as the anonymous donation. Are we clear?
Yes, ma'am.
Okay. So the anonymous donations are what? That they are given without any name. Okay. Now, let us look at this particular example. The following trusts claim that the anonymous donation received by them during the financial year are not liable to tax under 115 ABC. A charitable trust which applied the entire amount of anonymous donation for the purposes of the trust during the relevant financial year. What is the validity of this claim?
Not accepted, ma'am.
Correct. It will be applicable even in this case. Next is a trust established wholly for religious purposes which applied the 85% of the income of the amount of anonymous donation for the purpose of the object of the trust during the relevant financial year.
Only for religious purpose.
Yes. So in that case, it will be exempt.
Exempted.
Okay. Let us move further. Then income from the government grants or securities may be included in your statement of total income, and finally the capital gain. Now, when you talk about the application of the income, you first get the ad hoc exemption of 15%. But for claiming the ad hoc exemption, what is the condition? For the ad hoc exemption of 15%, what is the condition? You have to deposit it into the mode specified under section 11.5. So section 11 permits to put the 15% as the ad hoc exemption, provided that amount has been deposited in the mode specified in the 11.5. What are the 11.5 modes? Can you give the example?
Scheduled bank, post
Correct.
office.
Correct. Yes. Investment in immovable property, right? Or investment in the bonds of the public company, investment in shares, right? So,
Infrastructure debts.
yes, there are multiple ways in which this 11.5 gives the mode. So, only if you deposit it into the mode, then only you can claim the 15% ad hoc exemption. So, up to 15%, the income will not be taxable. Are we clear? Second is from the application, what balance 85% you need to apply. Now, the balance 85% that you have to apply, right? How will you apply that 85%? Let's say if I talk about the expenditure. When do you consider the application of the expenditure? Yes. Only when the expense has been paid. So when you pay for the expenditure to carry out the objects of the trust, only when you pay the expenditure. So expenditure are allowed as application only on actual payment, not when you incur it. This is irrespective of the method of accounting followed by. And this applies to not only the expenditure, but all the sums that you pay. And if you have paid the expense or payment in cash more than 10,000, then section 48.3, 48.3a, all that becomes applicable. Even when you pay the expenditure on which you have not deducted the TDS, or where you have deducted the TDS but you have not paid before the due date of 139.1, then 30% of the sum paid would not be treated as the application of income in that year. Are we clear? Okay.
Ma'am.
Then purchase of the capital asset. You can purchase the capital asset and claim it as an application. But the depreciation on the capital asset will not be allowed as the application because you have already claimed the purchase of the capital asset itself as the application. Fine. Then repayment of the loan. So if you have taken a loan and you utilize that loan amount for paying any expenditure or making any capital asset purchase, that will not be considered as the application. So application from any loan or borrowing is not considered as an application. It will be considered as an application in the previous year in which you repay the loan or borrowing, subject to fulfillment of these conditions. That the application from loan should be in India. Application from loan should not be paid as a corpus donation to another trust. The TDS is deducted on the expenditure paid from that loan amount. The application from that loan should not be in cash greater than 10,000. It should not be for the benefit of specified person under 13.3. And the repayment of the loan has been made within the 5 years from the end of the previous year in which the application has been made. Are we getting this particular point?
Yes, ma'am.
Okay. Now, let us look at this particular example in the module. MSO Foundation, a registered charitable institution set up on 1st April 2023, engaged in providing education and hotel management. The organization acquires a building in July 2024 for using the same for holding classes and office activities. It has approached you for your opinion on its eligibility to claim the cost of building and also depreciation in the current year and in the subsequent year. Advise the institution indicating the reasons. Would your advice change if the building has been acquired out of the loan taken from bank to be repaid in installments over a period of 7 years? Yes.
It is not allowed because building is used for classes and office activities, which is trade and commerce.
Hmm.
And this installment is paid over 7 years. So this is also not eligible because expenses should be paid within 5 years.
So here it is a charitable institution in providing education. Okay. So this is the object of the trust is the education in hotel management. And the building is not for the trade or commerce. It is for holding the classes and office activities of that particular education institution itself. So that is not the question over here. Now, when I purchase the asset, right, I will claim the amount as the application of income. However, it should be for the purposes of the objects, which is there. However, I will not claim the deduction of the depreciation as the application. If the building now has been acquired out of the loan, then it cannot be claimed as an application. I can claim the application when I repay the loan. So I have to repay the loan in how many years? Within 5 years itself. But if I pay within 5 years, I can claim on the repayment the application. Fine. Now, if I have not repaid the loan within 5 years, which is here at 7 years, so I will not be able to claim the application. But if I have not claimed the cost of building as the application because I have not repaid the loan within 5 years, then the depreciation on that can be claimed as application. Are we getting this? So if
Yes.
I should be then allowed something. If you're not allowing me the cost because I've not repaid the loan in 5 years, at least allow me the depreciation. You don't allow me the depreciation because I have claimed the cost as the application. Are we clear?
Yes, ma'am.
Okay. Next is VPS Foundation, a charitable institution registered under 12AB, set up on 1st August 2023, is engaged in providing education and sports management. The foundation follows accrual basis of accounting and during the previous year has accrued staff salary expenses pertaining to the March amounting to 5 lakhs. The salary was paid during the first week of April 25. KS, the tax advisor of the foundation, has advised them that the salary expenses will not be treated as the application examined.
Yes, ma'am, he is right because application is in that year whenever it is paid.
Correct.
So next year, 25, 26 will be
Correct.
paid.
Absolutely. Okay. Now let us move back to the application. What else can be considered? Amount from the corpus donation. If it is spent from the corpus donation, again, that is not considered as the application. So when you receive the corpus donation is considered as exempt, right? Unless it is the anonymous donation received as corpus donation. Now, if the corpus donation is exempt, any application that you make from the corpus donation will also not be considered as application of income. However, it may be considered as application of income in the previous year in which the amount is deposited back in the corpus. And how do you maintain the corpus? You put the amount in the mode specified in 11.5. So it will be subject to these conditions that the application from the corpus was in India. The application should not be paid as a corpus donation to another trust. TDS is deducted on the expense made from corpus. Application should not be in cash greater than 10,000. Application should not be for benefit of specified person under 13.3. And the amount is invested back in corpus within 5 years from the end of previous year in which the application was made. Same as the repayment of loan itself. So let us again look at the example. XYZ Charitable Trust is an educational institution registered under Section during the financial achieves the corpus donation of 25 lakh with a specific direction that the corpus should be utilized for setting up a science laboratory. The trust intends to set up the lab in the previous year 26-27 and will utilize the funds only during that financial year. In this regard, the trust wants to understand whether the corpus donations are exempt under limit.
Yes, it is exempt. If it is deposited in 11.5 modes, then
Correct.
that amount will be exempt.
Correct. Absolutely. Okay. Now, next is donation to a trust registered under 12AB or 1023C, irrespective of the object of trust. So if you pay donation to another trust, it is considered, you can take that as an application of income, irrespective of what the object of the other trust is. However, if you pay the amount towards the corpus donation of the another trust, or if the amount is paid out of the accumulated income of the trust. That is, if you do not pay from the current income, you pay it from the accumulated income. That is, the income of the earlier years that you have accumulated and deposited in the modes 11.5. If you pay out of that amount to another trust, then it is not considered as application. However, even if you pay from the current income, the application which will be considered is only to the extent of 85% of the amount of donation, not the entire 100%. However, there is a CBDT circular in that respect. What does the CBDT circular say? That if I consider, let us look at the module again. What it says that any amount which is paid as a donation to any other trust other than in the form of corpus donation considered as the application if it is paid out of the current year income. Only to the extent of 85% of the amount credited or paid. Fine. So let us say, for example, if the 300 is the income of the trust, or let's say here the 100 is the income of the trust, and 15% is my ad hoc exemption, right? So what I have to apply balance is only 85%. In this case, let's say I give 100 rupees as a donation to the other trust. So what will be considered as the application of income? 85, right? So still, here 85 was required to be applied and I have applied 85 itself. So what will be the income of the trust? Nil. Are we clear? But let's say, for example, if the 300 is the income of the trust, out of which 15% is the ad hoc exemption. So what I have to apply is 255, 85%. And let's say I have made donation to other trusts is 100. Now what will be considered as the application of income? 85. Now how much more I need to apply? Yes?
15.
15. But what about this amount? The 15 that I do not have it because I have already applied 100. See, 300 was my total income. Fine. Out of which 100 I have already given to another trust. So what I'm left with is 200. Right? So now you are asking me to apply the 15% of this, because by taking 85% as the allowable application, the 15% you are still asking me to apply, which I have already given to another trust. So how will I be able to apply? I will not be able to apply. Are you getting this point? So what the CBDT circular is saying is, CBDT circular of 2024 is saying that where the donations are made by the trust to another trust, where only to the extent of 85% is considered as application. So where I have donated 100 rupees, but only 85 is considered as the application. So balance 15 is yet to be applied. Right? And if I do not apply it, it will be considered as my income. But how will I be able to apply if I don't have the 100 rupees? I don't have the 15 rupees in hand. How will I apply? How will I enter more specified in it? As I have donated entire 100 rupees. I don't have 15 with me. So the CBDT has clarified that this 15 rupees shall not be required to be invested in the mode specified in the 11.5. Are we clear? So if you look at this first example, where 255 is considered for the application, out of which 85 have applied. But I have donated the entire 100 rupees. So in hand, I have 300 minus 100, only 200. So the application that will be considered will be of this 200, the 85% of 200 I need to apply and not of the 300 minus 85. I need to consider of 300 minus 200. That amount I need to still apply. Are we getting this? So 200 ka 15% is what I should accumulate or invest in the mode specified in 11.5. So entire 300 will be claimed as the exemption. Are we clear? Yes?
Yes, ma'am.
Okay. Next, what else is considered as the application? Now, if the trust is not able to apply 85% of its income for the expenditure during that year, maybe because the trust has not received the income, because the income has accrued to the trust but has not been received, or the income is received late, because of which I can't apply, then there is an option given to the trust to defer the application in the next year, but it will not be considered as income of this year. It will be considered as deemed application. Provided the condition is that if the trust has not received the income, the condition is it will be considered as deemed application. We will not tax that income. The income should be applied in the previous year of receipt of income or in the next following previous year. So where, let's say, for example, we are looking at previous year 25-26 and the income has not been applied. So if the income is received in 26-27, then it should be applied in 26-27 or by the 27-28. If it is not applied by previous year 27-28, then this will be considered as the deemed income of previous year 27-28 and which will be taxable under section 115 BBI. Or if the income is received late, then also the trust has an option to claim it as a deemed application, provided the income is applied in the next year itself. And if it is not applied, it will be considered as deemed income of previous year 26-27. Now, how the trust can exercise this option? The trust can exercise this option by filing Form 9A. And that has to be filed 2 months prior to the due date of return of income. But the CBDT has relaxed that and said you can even file it by the due date of return of income, even if you don't file 2 months prior. Are we clear? So,
Yes, ma'am.
if you look at this question, during the previous year ending 31st March 25, a charitable trust earned an income of 1 lakh, but it has only received 60,000. The balance of 40 is received in 25-26. So 1 lakh minus deemed application 15%. Balance 85% is 85,000, out of which I have only received 60,000. So I will consider amount applied as 60. Amount deemed application as 40, but I have to apply this by the next particular year. If I do not apply in 25-26 or in 26-27, this will be considered as deemed income of that particular year. Similarly, if I receive 50,000 on 30th March, then it will be considered as deemed application provided I applied by the next year. Yes or no? Any
Yes,
questions, any doubt? Okay. Next is, if I, let's say, for example, don't want to apply this year, I can accumulate the income. So the trust gets the option to accumulate the income for a specified purpose. So the trust has to exercise that option by filing Form 10. And in the Form 10, it has to state that why it wants to accumulate the income. Let's say it wants to purchase a building. Let's say it wants to purchase a machinery. So it has to give that particular detail and the period for which it wants to accumulate. Now, the maximum period for which it can accumulate is 5 years. It can maximum accumulate for the period of the 5 years. Now, let's say, for example, if I do not apply that income for the charitable or religious purposes, or I cease to accumulate the amount, I have to accumulate it in the modes specified under section 11.5. And I cease to accumulate the amount. Or I cease to make it invested in the modes in 11.5. Or I have not utilized for the purpose for which it was accumulated. Or I pay the amount from the accumulated income to any other trust. Then in that particular case, the conditions will get violated. And in that case, it will be considered as a deemed income under section 115 BBI of the previous year in which the income is applied for other than charitable religious purposes, or it ceased to remain invested, or it is not utilized for the purpose for which it was accumulated in the last previous year by which it was to be applied, or if the income is paid to that trust. So the trust gets this option. It has to exercise this option by filing Form 10 on or before the due date of 139(1). Are we getting this particular point? Otherwise, it will be considered as the deemed application. Are we clear?
Yes, ma'am.
Okay, so you have to be very, very careful in respect of these kind of questions. So it can be considered as a deemed application in the case of the accumulation. However, you have to utilize that amount within that period of maximum, the amount that you have stated in your application. Now, when the trust has a capital gain, what will be considered as application in respect of capital gain? Where the transfer of the capital asset, which is there, is in that case, the sale consideration is entirely utilized for acquiring the new asset. Where the entire sale consideration is utilized for acquiring a new asset. Then the application from the capital gain would be the capital gain itself. The entire capital gain would be considered as deemed to have been applied. However, if only a part of the consideration, sale consideration, is utilized in acquiring the new capital asset, then the capital gains which will be considered to have been utilized shall be the cost of the new asset minus the cost of the old asset. Are we getting this? So, let us look at this example. Where the original cost of the capital asset is 1 lakh, consideration for which it is transferred is 1 lakh 50. The cost of the new capital asset is 1 lakh 50. So in situation 1, my capital gain is 50,000, 1 lakh 50 minus 1 lakh, and I have invested the entire sale consideration in the new asset. So 50,000 will be considered as the application. Where in the second case, out of 1 lakh 50, I have only paid 1 lakh 20 for the new asset. So what will be considered as my application? 1 lakh 20 minus 1 lakh.
20,000.
20,000. Are we clear?
Yes, ma'am.
Yes. Any question, any doubt? Okay.
This income will be first we have to take in gross receipt and then we have to take this amount
Correct.
in proportion. Okay.
Correct. Okay. Any doubt, any question? Fine. Yes, everybody, is it clear? Okay, let us move further then. So, now, if you look at the deemed income, Section 115 BPI, we discussed, in what cases deemed income concept gets triggered. What are the cases in which the deemed income concept gets triggered under 115 BBI?
Corpus donation paid to another trust. Then section anonymous donation BPA 115.
No,
Right?
no. See, 115 BBI, there are these cases where it gets triggered, where the income which is accumulated and the accumulation of the income is not allowed under any specific provision of the Income Tax Act. Where, let's say, for example, you have not filed Form 10, or if the income which has been accumulated is not applied for charitable purposes or religious purposes, then it will be considered as deemed income of the previous year of violation. Or the income ceased to be accumulated So it will be deemed income of previous year and when it ceases to be accumulated. Or when the income ceases to remain invested in mode specified in 11.5. So it will be the previous year in which it ceases to remain invested. Or if the income is not utilized within the specified time frame for the specified purposes which you have declared in Form 10, then it will be the deemed income of the last previous year by which you had to apply it. Or income, the accumulated income is paid to any other trust. Then in the previous year in which you pay to the trust, it will be considered as deemed income. Or if the income is not received during previous year and you have exercised the option of deemed application, and in the next year or following year, you have not actually applied the income. Or if the income is received late and you have not applied by the next year when you have exercised the option of deemed income, deemed application. Or when the income is applied for the benefit of the prohibited person under 13(3). In that case, it will be considered as the specified income, deemed income under 115 BBI, which shall be taxable at the rate of 30%. Which shall be taxable at the rate of 30%. Are we clear? Now, in certain cases, your exemption can get denied under Section 13. Your exemption can get denied under Section 13. What are the situations in which the exemption can get denied under Section 13? Number one, the income from the trust is applied for private religious purposes or for any particular religious community or caste. It will not include the, for the benefit of scheduled caste, backward classes, or scheduled tribe, or women or children. We're not talking about that. But if you're promoting only one particular community or caste, let's say for Gujaratis, let's say for, South Indian, whatever, you say, then the exemption will not be available. The exemption shall be denied. Or the income of the trust is applied for the prohibited person or specified person under 13(3). Now, who are the specified person under 13(3)? We'll look at it. Or if the income is deposited in the modes other than the Section 11.5. Other than the Section 11.5. So in that particular case, your exemption can get denied. So if you do not deposit it into the mode specified under Section 11.5, then the exemption itself will get denied. Are we clear? So it will not be applicable if, let's say, for example, this particular point, that if the funds are deposited otherwise than in the mode. If let's say, for example, the assets in which it is invested, which are not covered under 11.5, if those assets are held for not more than 1 year, if I have, purchased certain assets which are not covered under the modes of 11.5, but these assets are held for less than 1 year, then the exemption will not be denied. Or if the funds are invested into any other asset which is not covered under 11.5, but these funds are invested out of my business income. It is not invested out of the charitable or religious income. And I have kept the separate books of accounts for that. Then in that particular case, there will not be any denial of exemption. Are we clear? Or if I have maintained some jewelry or, furniture, that is not a problem. So Of course, mode specified in 11.5 doesn't include furniture. That is fine. I can hold the furniture as a trust. I can have an office as a trust. I will hold the furniture. I will hold some jewelry if I'm maintaining some temple. That is fine. That will not result in denial of exemption. However, if I hold, shares of some company which is not a public sector company, which is not a prescribed mode of investment in 11.5, then the exemption will get denied. Are we clear? Then, if I have done any kind of, you know, uh, given the particular payment for the, let's say, anonymous donation I have received, that shall result in denial of exemption to the extent of 5% of total donations or rupees 1 lakh, whichever is higher. So only to the over and above that amount, I will not get exemption because that amount will get taxed at flat 30% under 115 BBC. And that will also include the corpus donation received as the anonymous donation. Or if my trading receipts exceed 20% of the total receipts, then also the exemption will get denied. If my object is advancement of the general public utility. Or if I do not submit Form 10, if I want to accumulate the income and I have not submitted the Form 10 by the due date of filing of return of income. Or if I have not furnished my return of income itself. In that case, the trust will be denied the exemption. And if a trust is denied the exemption, then the income shall be chargeable to tax as per the normal provision. So if a trust has receipts more than 20% of total receipt, or it fails to maintain the books of accounts, or it fails to get the books of accounts audited, or it fails to file the return of income, then in that case, the trust will be assessed to tax as per the normal provision. Are we clear? Yes or no?
Yes, ma'am.
Now, in the case of the income being applied for the benefit of the prohibited person. Now, who is the prohibited person under 13.3? The prohibited persons are the author of the trust or the settler of the trust or the founder of the trust, where the contribution has been made to the trust or institution that is more than 50,000. A person with a substantial contribution. It is not 1 lakh, it is 50,000 over here. Let us look at from the module itself because this has changed this attempt, but for your attempt, it is 50,000. Where the author, founder, or the person is a HUF and any member of the HUF. Trustee of the trust. Relative of the author, the trustee, or the manager. Or any concern in which the above person have a substantial interest. What do we mean by substantial interest? Where the concern is a company, if equity shares carrying more than 20% of the voting power are beneficially owned by these persons. And in any other case, where the concern is other than company, where the person is entitled to more than 20% of the profit. And who are the relatives? What is the definition of relatives of these persons? Spouse, brother, sister, lineal ascendant, lineal descendant, brother, sister of the spouse, and spouse of the above person. Are we clear? So these are the prohibited category of person. Now, when it is said that the income is applied for this benefit of the specified person, it has been deemed to be applied, it will be deemed to be applied for the benefit of a specified person, where the loan is given without the adequate interest or adequate security, where the property is rent out to this person without adequate rent, or if the excess payment is made for the services availed, or the remuneration received by the trust for any services rendered is inadequate, or for the purchase of property excess payment has been made, or if the sale has been made by the trust for any property inadequate consideration has been received, or if there is diversion of income on property exceeding 1,000, or if there is investment in the substantial interest concerned. So if the funds of the trust are invested in any concern in which the specified person have a substantial interest, then it will be considered that the income is applied for the benefit of specified person. However, where the funds invested in the concern does not exceed 5% of the capital of that concern, in that case, the exemption will be denied only in relation to the income from the investment, not the entire income will get, the entire income will not be, denied the exemption. Only the income from the investment will be denied the exemption if the investment is less than 5%. Are we clear? What are the other repercussions in this case? The other repercussions are, in the hands of the trust, there will be denial of exemption. The income will be taxed under 115 PPI at the rate of 30% on gross basis as a deemed income. Plus, there will be penalty in the hands of the trust under 271 AE. What is the penalty? Penalty is 100% of the amount of income so applied where the violation is noticed for the first time, and 200% where the violation is noticed again in the subsequent year. And in the hands of the specified person, 56(2)(10 will be applicable. So usually 56(2)(10 does not get attracted if the income is received from a trust or institution. However, in case the income is received by a specified person, 56(2)(10 will continue to be applicable. Are we clear?
Yes, ma'am.
Okay. So now, when does the trust registration can be cancelled? So the CIT or PCIT has the power to cancel the registration of the trust. If he observes these instances, he has the power to call for your books of accounts and to cancel your registration altogether. So what are the instances in which the registration of the trust can get cancelled by the CIT itself? So where he has noticed the occurrence of these specified violations. What are the specified violations? Where the income is applied for other than the objects of the trust, or where the trust has the profit and gains from business which are not incidental to the objects, or the separate books of accounts are not maintained if the PGBP is incidental to the object, or the income is applied for the private religious purposes or for the benefit of any particular religious community, or the activities are not genuine or not carried out in accordance with the conditions of the trust, or it is not complied with any other law, or applied for registration with the false information. Then in that particular case, the CIT can cancel the registration after calling for the documents and then pass an order in writing, and after giving the opportunity of being heard. Now, once the registration of the trust gets cancelled, then there invokes the concept of the accreted tax, tax on the accreted income, or what we call it as the exit tax under section 115 TD. Now, what does this 115 TD provide? It says that if the trust has claimed the exemption on income and tomorrow the trust stops doing the charitable activity, so whatever exemption we have given all over the years, in the understanding or with the understanding that this income will be applied for charitable activities. But now you're no more a charitable trust. And therefore, now, after claiming all this exemption, your assets now you can use freely for non-charitable purposes. So that is not possible. So we will levy you the accreted tax or the tax on the accreted income or the exit tax, because all this while you have been claiming exemption and this amount you have put up in the form of assets. So on your assets, we will levy the tax. Because now you have to pay an exit tax to become a non-charitable organization. Right? Because you accumulated that exempt income in the form of assets. You have applied that in the form of assets. So whatever assets that you have, on that you will apply this tax. At the rate of 30% plus cess of 12% plus 4% surcharge, which makes it to 34.944%. So on which cases, conversion of trust into a non-eligible form or a non-charitable organization. A trust will be deemed to be converted into a non-charitable organization where the trust registration has been cancelled, or where the trust has undertaken the modification of objects and has not applied for fresh registration. I told you at the start itself. Or it has applied for fresh registration, but the application has got rejected. Or it has got the provisional registration, but it has not applied for the final registration. Or where the final registration was given, but it has expired and it has not applied for re-registration. Are we getting it? Or it has got merged with any other entity or any other trust, which is not a charitable trust. Are we getting this point? So if it is merged with an entity not having the same objects and not registered under 12A or 12AB. However, the exit tax will not apply if it merges with the other trust which has same objects and the trust is registered under the 12AB or 1023C. Or if the trust on the dissolution has failed to distribute the assets within 12 months from the date of dissolution to another trust. So this is the 115 TD becomes applicable. Now accreted income, it will be applicable on accreted income. What is accreted income? Aggregate of the FMV of all the assets as on the specified date minus the total liability. What is FMV of total assets as on the specified date? What is specified date? So the specified date is in case the registration is cancelled, date of the cancellation. In case the objects have been modified, date of modification. In case where the application has not been applied, fresh application has not been made, provisional application has expired, fresh application not made, renewal not made, then last date of making application. In case of merger with any other trust not having similar objects, date of merger. And in case of the dissolution, date of dissolution. So FMV all will be taken on that date. Now, what does the FMV include? FMV of assets mean for the immovable property, it will be the stamp duty value of immovable property or the open market value, whichever is higher. For quoted shares and security, it will be the average of opening plus closing on the specified date. Or if on the specified date, there was no listing done or trading done, then prior to that date. In case of unquoted share, it will be A plus B minus L into PV divided by P. A is equal to book value of all assets minus income tax plus income tax refund minus unamortized expense. B is the FMV of jewelry, painting, immobile property. And L is the book value of all liabilities, excluding paid up share capital, reserve surplus, contingent liability, provision for tax, provision for uncertain liability. P is equal to total equity share capital, and PV is the PV of that equity share, paid up value of that share. And for other than equity shares, you will take the value as per the valuation report. From the FMV of total assets, you will exclude the assets which are made out of agricultural income because they are not made out of the charitable income. Assets and liability generated out of income prior to the registration. So prior to the registration, any which ways you had a taxable income. So we will not include those assets. And assets and liabilities which are transferred to another trust within 12 months from dissolution. Of course, if you have fulfilled those conditions, we will not include those assets. Are we clear? So let us solve a question from your module. Yes. Serving the poor, a charitable trust is registered under 12AB. On 1/4/2024, it got merged with under another entity not eligible for registration under 12AB or approval under 1023C. All the assets and liability became the name of the. So here, what is given in the question is now, the trust appointed a registered valuer for the valuation of its assets and liability. For the following particular, calculate the tax liability in the hands of trust arising as a result of merger. With respect to stamp duty value of land held rupees 15 lakh, however, if this land is sold in the open market, it would fetch 17 lakh. The book value of the land is 20 lakh. What will you take here? For the land, what will be the value that we will take?
17 lakhs.
17 lakhs? Yes, that's correct. Because the open market value is higher. 75,000 equity shares in Inc. Limited traded in Delhi Stock Exchange. The lowest price per share on 1/4/24 was 75 and the highest price on that day was 85. The book value was 67 lakh. Now, what is the specified date here? 1/4/2024, isn't it? Because it got merged with that entity on that day. So what will be the value of the shares?
It is average of highest and lowest, so 80 rupees.
Yes. 75 plus 85 divided by 2 into 75,000 equity shares. So will be 60 lakh. 55,000 preference shares held in N Limited, the shares will fetch 44 lakhs if they are sold in open market on 1/4/24. Book value was 25 lakh.
Open market value 44 lakhs.
Corpus fund as on 1/4/2024, 15 lakh.
It is not taken, ma'am.
Correct. It will not be included in liabilities. Outside liabilities, 90 lakh.
It is reduced from.
Reduced. Yes. Provision for taxation, 5 lakh.
It is not taken.
Not taken. Liabilities in respect of payment of various utility bills, 6 lakh.
Reduced from total assets.
Correct. So based on this, you will calculate the aggregate FMP minus the total liability. You will get the accreted income and you will get the tax liability 34.944% on that. Simple. Let us look at this question now. Helpage is a charitable trust set up on 1/4/10 with the object of providing relief to the poor. Later on, in April 12, it changed its object to medical relief. It applied for registration on the basis of its new object on 1/9/2012 and was granted the registration on 1/2/2013. On 1/4/2024, Helpage got merged with Poor Aid, which is not eligible for registration under 12AB or 1023C. all the assets and liabilities of the erstwhile trust became the assets and liabilities of poor A. The trust appointed a registered valuer for the valuation. From the following particular, calculate the tax liability as a result of merger. Now, with respect to this land in Noida, which is purchased on 1/9/2010, the stamp duty value, open market value, and the book value as on the specified date of 1/4/2024 is given. So, what will be considered here?
Noida land will not be taken because it is
Correct.
purchased before this.
Correct. So, the land trust has obtained the registration in 2013, and the land of Noida has been purchased in 2010. So, therefore, it is well before the purchase, before the registration has been purchased. So, this will not form part of my asset. What about Gurgaon?
120 lakhs.
It is purchased after my registration date. So I have been granted the registration in Feb 13th. This is purchased in September 13th. So I will consider that. Now here the open market value is 120. Stamp duty is 100. So I'll take 120. Coming to the shares, 5,000 quoted equity shares of A Limited. Your date of purchase is given, face value is given, purchase price is given, open highest lowest is given, and the open market value is given.
Average of highest lowest 310.
310 into 5,000 equity shares. Then preference shares 2,000 purchased in 1/9/2015.
Open market value 180.
2,000. Yes. Now coming to the book value of liability, this is 120 lakh. This includes a corpus fund of 12 lakhs. So you reduce the corpus fund from this amount. You will reduce the provision for tax 8 lakh, and you will reduce the reserves and surplus 18 lakh. So this will give you the asset minus liability. Is this clear, students?
Yes, ma'am.
Okay. So from the liability, you need to exclude the corpus, reserve and surplus, contingent liabilities, provision for uncertain liability, and the provision for tax. Okay. Any questions? Any doubt? Fine.
Yes, ma'am. Thank you.
Yeah. Okay. Now last part is taxation of private trust. So private trust is not something wherein public are interested. So it can be form of two. It can be a revocable trust where the transferor has the power over the income or assets transfer. He can take back the income, he can take back the assets, or income can be retransferred to the transferor, or he still controls the assets or the income. In that case, it is considered as a revocable trust under Section 63, and the income will continue to be taxed in the hands of transferor only and not in the hands of trust. However, if it is an irrevocable trust where the transferor does not derive any benefit from the income or asset, and it is irrevocable during the lifetime of beneficiary, then it will be taxable in the hands of trust itself. One more important provision in respect of trust: income from the asset transferred for the income from the asset transferred to a trust for the benefit of spouse or for the daughter-in-law for inadequate consideration will be clubbed in the hands of transferor itself. Right? Now, if it is a specific trust and if it doesn't have the business income, then the income will be taxable in the hands of beneficiaries at the slab rate. If it has the business income, it will be taxable at MMR. The only exception to that is if the trust is for the benefit of relatives, in which case it will be taxed at slab rate. If it is a discretionary trust where the shares of the beneficiaries are not known, now if they have no PGBP, then also at MMR. If they have PGBP, then also at MMR. Okay. The only exception is if it doesn't have PGBP, then if it does not have any beneficiary which have income greater than the basic exception limit, and the beneficiaries are not beneficiaries in any other trust, or the trust is created under will, then it will be taxed like an EUP. If it has a PGBP, then it will not be taxed at MMR if the trust is created under will. It is the only trust of settler, and it is for the benefit of relatives, in which case it will be taxed at slab. Next is the political parties. The income of the political parties is exempt under 13A, and for the electoral trust under 13B. What are their exempt income? IFHP, IFOS, capital gain, and voluntary contribution. There's a conditional exemption which has been given, provided they maintain the books of accounts, they maintain the records of the voluntary contributions more than 20,000, they do not accept any cash donation more than 2,000, and they are furnishing the ITR. This is also applicable, remember, for a trust also, not the, accepting the donations in cash or all of that, but even the trust has to mandatorily file its return and get the books of accounts audited and also maintain the books of accounts. Are we clear? Same case is for the electoral trust also. So a political party electoral trust have to maintain these records of the, the donations from which they are received. Only then they can have the exempt income. Are we clear? Fine.
Yes, ma'am. Ma'am, they have to make these records, but if their income is less than basic exemption limit, then also they have to do.
Yes, they have to still do.
And
They have to
audit
still
is
do.
also compulsory.
Yes, the audit is also compulsory. Yes. Let us solve a question on this from the module and then we'll close the session. So, the books of accounts maintained by a national political party registered with Election Commission for the year ended 31st March 25 discloses the following receipts. Rent out of property to a departmental store at Chennai. What will happen to this?
Exempt if books of accounts maintained.
It is exempt, right? Interest on deposits other than banks. This is also exempt,
Exempt.
right? Contribution of 21,000 each from 100% who have secreted their names, which is anonymous basically.
Is taxable.
So here basically the political party has not maintained the records of the donation exceeding 20,000. So in that particular case, it has violated the condition. So it has to maintain a record of this contribution of 30,000 with the name and address. It can't be anonymous donation. So therefore, they will not be eligible for exemption, even in respect of rent and interest. So the rent will also be taxable, but what will be taxable is 6 lakh minus 30% standard deduction. Right? Secondly, contribution from 10% by way of electoral bonds of 25,000 each. Now, this will also be taxable. This is voluntary contribution. Cash contribution at 2,100 each from 1,000 members. Again, they are violated. And net profit of cafeteria run in the premises of Delhi. So all of this will get taxable in the hands of the political party. Are we clear? Okay.
Ma'am.
Yes. See, the institute has given the alternative solution. This is one way to deal with it. The second viewpoint is that you can only say that this 21 lakh and this 21 lakh is taxable. Rest other is exempt. And of course, the net profit of cafeteria. So even if you have violated the condition, what you have violated the condition, only that income should get taxed, not the entire income. So there are two viewpoints and you can make a viewpoint in the examination. Clear? Okay. So with this, we will stop here. In case you have any questions, I'll be happy to take it up. Otherwise, we can close the session.
Both the way we have to do the question in exam.
See, you can write one view and write an alternative view in the exam. Don't do the entire question again, but just write an alternative viewpoint. That this is also a possible viewpoint. So you can write like this. Alternatively, the political party can contend that only 45 lakh is taxable on account of non-maintenance and receipt of cash donation, in which case the total income shall be computed in different manner. That's it. You can write like that. Or only 45 lakh shall be taxable. You can write like that and do not present this. Okay?
Yes, ma'am. Thank you.
Okay. So in the next class, we will continue with the next chapter, which is non-resident taxation. So please revise and come so that we have a good discussion in the next class. Thank you so much.
Thank you, ma'am.
Thank you. Yes, done. Thank you.